Welcome back to the Commercial Real Estate Investor Podcast. My name is Tyler Cobble, your host, and today we are in the studio with Brent Bythewood. We're going to be going over some very interesting tips on how you can secure financing for your projects in 2023. It's a very interesting world out there right now. We all know interest rates, right? What a time to be a real estate investor.
Yeah.
You know, all of your money is incredibly expensive and it's difficult to get deals done. It's a lot of fun.
Absolutely.
But real quick, this episode of the Commercial Real Estate Investor Podcast is brought to you by CRE Launch Pro. That is my new course that we recently launched in the last few months. And it is designed to take you from absolute beginner all the way through confidently buying your first property. So if you want to learn more about that, go to www.crelaunchpro.com. Well, Brent, that was a very brief introduction of you. Everybody knows you're a commercial lender in the Southeast because you're based in Nashville.
Based in Nashville, cover Tennessee, South Carolina, North Carolina, Georgia, Mississippi, Alabama, just to name a few. So.
Yeah. So the great thing is somebody comes to you, they can get deals done in all of these states.
Absolutely.
Yeah.
So we can certainly entertain. Absolutely.
I love that, man. Well, that's a brief introduction to you, but like, give us a little bit of your background. How'd you end up here?
Yeah, so originally from Cincinnati, Ohio, grew up there, went to school at University of Alabama, came back up to University of Cincinnati, and then met my daughter's mother, who we fell in love and moved to Indianapolis. Was actually a residential realtor over in Indiana.
I didn't know that.
So yeah, and then she got transferred down to the great city of Nashville, Tennessee, and been here now for 12 years and found myself kind of contemplating my career, and that's when I made the switch into banking. So I started out on the retail side at one of the larger regional banks and quickly discovered that I don't like four walls around me. And so started entertaining opportunities. Yeah. So started entertaining opportunities within the banking world, but outside. So spent some time in treasury management, fell in love with working with businesses and entrepreneurs, and then made the switch over to commercial lending. So
I love it, man. That's a big switch. What was the biggest thing that you found, like going from being on the deal side to, I guess, being on the opposite table on the deal side?
Absolutely. The one thing that I look back on, I apologize to all the lenders that I worked with that I was judging behind my phone or behind my computer screen, because the lending side is just as competitive and just as quirky as the sales side. So.
Oh yeah. Well, and it's, you know, people don't really understand what the decision process looks like. Like, yes, I have my lender that I am pitching on the deal, but let's talk about that. What is the behind the scenes? Like,
yeah,
I'm pitching you a deal. I give you my offering memorandum. I give you my financials. You're not the guy that says yes. So what is the whole process behind the scenes actually look like?
So what I'll say is I'm the first yes. But then in my particular situation, I work for what's called a credit union service organization. And so what that means is I actually work on behalf of 7 credit unions. All throughout Middle Tennessee, 2 over in Knoxville, 1 up in Bowling Green. And what it looks like is I get the offering memorandum, I go through the finances, I do a preliminary underwrite. I say, hey, it meets all the metrics and expectations that we need. I send it off to my underwriter. He underwrites it, all within a timely fashion. I say probably 48, maybe 72 hours before I can get a proposal letter back to my borrowers. And then from there, we put it in front of the credit unions, and they give us the official yes or no, whether they're willing to commit to it. So there are some moving parts, similar to banking. Within the banking world, they have to go in front of their loan committee instead of the 7 credit unions. So it's the same process, just looks a little bit different as far as time frame.
Yeah. So what is the difference between a credit union and a bank?
Yeah. So that's a great question. So the credit union is what I would kind of equate it to as a community bank feel. You get to know your well, in my case, I get to know my borrowers, but as a client or as a member at the credit union, you get to know everybody within the branch. You also get to know some of the executive level employees, and the best part about the credit union is the underwriters get to know you as a borrower real quick. So you do 1 or 2 deals and they know exactly what you.
It makes a huge difference.
Yeah, absolutely. So,
because, you know, I mean, especially with like the kind of real estate that we do, right? It's very out of the box. It's not, we're not going to buy a 3-tenant strip center and
Exactly.
put, T-Mobile in there. I mean, we do very different deals. So, when an underwriter looks at these deals, they're like, but if they know your background and who you are and your history and they understand how you operate, it totally changes your process.
History in your situation is so important. We're able to look at your past deals and see exactly what you've accomplished and what you've done. Congratulations, by the way, on
Thanks,
your
man.
success.
It's been fun.
Yeah, I can definitely see it in your face. But with that, I look at all of the past deals that you've done. I look at where they're, where they currently are within the market and where they are with the rents. And then I'm able to put that in front of the underwriter and say, hey, here's what's going on. And then when we're working together 2-3 deals later on down the road, they know exactly what to expect out of you.
Yeah. I mean, it makes all the difference in the world. It's tough because, when I was first getting started, I didn't have a track record and I still wanted to do crazy deals. Yep. And so I ended up having to bring, co-GPs or co-sponsors into the deal in order to secure the debt. And that problem has only kind of amplified the bigger that we've gotten because, now we're just doing crazy deals at the $10 million, $20 million scale instead. And so it's kind of funny because I spent all that time building relationships with these banks that when you're doing a sub $5 million deal, it makes all the sense in the world. Like they get used to it. But as soon as you get out of that box, now you got to go start building a better relationship with other lenders that you haven't traditionally done. Because I don't know if y'all are very familiar with this, but in banking, a lot of banks have a single user limit on how much capital they can actually give you. That might be $5 million for a very small bank. Mm-hmm. It might be $15 to $20 million for a more regional sized bank, and of course it can get much larger than that. So how do y'all handle that? Because I know like you said, you've got 7 different credit unions that you work with, and so if one credit union, if it goes out of their max, how do you handle that?
Absolutely. So the great thing about having 7 credit unions is I'm able to disperse the risk, right? So on a typical transaction, I have to have a lead lender, is what that looks like. And that's who's on the promissory note. And that's who we, put as the lead. From there, if we reach our max with that particular lender, then I'm able to go to one of my other credit unions and have them as a lead. And they all disperse like I said, the risk, but also the funds, typically equally. So 12.5% roughly, they'll all take on at one particular time.
And what happens if one says no? Can you not raise money from any of them?
And so if one's out, I may ask for more from one of the other credit unions, or we also have large, credit unions throughout the country that we're able to go to secure more funding.
Yeah, it's pretty interesting. I first got into this world back when I did a deal up in Old Hickory Village, which is how you and I got connected.
Absolutely.
Because there was the Old Hickory Credit Union was right down the street, and I had no prior experience with credit unions. And they were like, "Oh, you got to come in and check it out." And that, I walked in the bank, and that was a huge bank. Yeah. I mean, obviously, it was way bigger than what they really needed at the time. And it was a funky little building.
Yeah.
With basically half of the building, like probably 6,000 square feet or more, like underground with no windows at all.
Absolutely.
So their new space is amazing.
Oh yeah.
But yeah, that was they introduced me to like every single person in the bank, which was really cool. You don't usually get that, right? You get introduced to maybe just the lenders.
Yeah.
And then they financed my car.
Oh, so that's amazing.
Which was pretty cool.
Yeah.
Usually, you finance through the car dealerships, and that is expensive. Yes. Whereas Old Hickory Credit Union gave me a much better rate.
Go straight to them.
Yeah.
Yep.
It was way better.
Yeah.
If you're watching us live, feel free to drop your questions in to the live chat there, and we'll get around to it. Brent, I've got probably 6 or 7 questions I want to ask you from our Discord channel and from Instagram that people have. But before we do that, I want to dive into like the environment right now.
Yeah.
So, 12 months ago, everybody was happy-go-lucky. I mean, just walk me through your experience on the lending side from like June of last year until June of this year.
No beating around the bush here, Tyler. Last year, if you would, I would say 12, 15 months ago, if you would have told me we were going to be in the environment that we're in, I would have said you're absolutely crazy. We were churning and burning last year. But to give you an idea, out of the 10 deals that I would see within a week or two, 1 or 2 of those would be a perfect fit for us, because that's one thing with lending and with
picky,
investors. Find the right fit. and be quick to give an answer of yes or no, right? And it might not be a good fit, but it might be a good loan. And so shop it around, see what it looks like. But I would look at 10 deals, and 1 or 2, 3, 4 would be within the metrics that we're looking for, hitting a 1.25 debt service, within the loan limits that we were able to work with. Now what we're seeing is 1 out of maybe 25, 30 deals is within the metrics. And right now, leverage is key in the banking world. We're up against higher rates. We're seeing anywhere within the market. We're seeing low 6s with agency debt, as well as life co companies, all the way up to 8.5% with community banks that may have to go off of prime. So there's a large spectrum of rates that we're seeing. Typically, most financial institutions are right in between that, I would say 6.5 to 7.5% mark. With the increase in rates, with the prices still remaining high, and then with the rents remaining relatively low. If you're renting, I know you'd argue that fact, but
Right.
to justify the prices, we have to raise the rents and hit the debt coverage that we need to be able to finance the deal.
It's pretty wild. I mean, I've never been in an environment. I've been in it 10 years, but in real estate, I've only been in it 10 years.
Yep.
And, it was 2013. It was a very different time. I have never seen such a vast spread between the differences of rates, right? I mean, you're talking about low to mid 6s all the way up to mid 8s.
Yeah.
And in some cases, even higher.
Yeah.
I seller financed a deal last year and put it on a floating, an arm, which was the best thing that we could have possibly done, because he's been paying us like 9.75% interest a month. But that was because he kind of backed himself into that corner. I'm usually a really nice guy. We probably would have given him a much better rate, but while we were under contract, he threatened to sue me, and I don't like that word.
Yeah, that's when your rate goes up.
Yeah, that's when your rate goes up, So just if you're listening, don't throw the S word around willy-nilly.
If there's litigation thrown out, yeah.
So why do you think that there's such a big difference between rates at Life Co. all the way up to your community banks right now?
That's a great question. And honestly, we're still studying it and still trying to figure out, to give you an idea, I looked at a deal today, earlier this morning, that my competition was much lower than I was. It fit in their category more than it fit in mine. And so they were more aggressive on the pricing than what my credit unions would have felt comfortable with. Obviously, the credit unions have to cover their spread and cover any costs that they're incurring. And so that's why you see different banks, different institutions, we'll call it, because we're talking credit unions and banks. Different institutions have different rates because their appetite may be different. Their liquidity situation may be different. And so obviously that L word is getting tossed around a lot in 2023. And, thankfully I've got credit unions that are willing to lend, but it also has to make sense to them.
Yeah, the good old dry powder.
Yes,
everybody
absolutely.
Likes to call. I feel like I have not heard that phrase so many times in my entire life as I have in the past couple of years. It is crazy how much people are just throwing dry powder.
Yep.
So what do you see coming out of the environment right now? I mean, I know the Fed decided last week they're not going to raise rates.
Yep.
At that time.
Thankful for that.
That's a huge difference. But there are analysts out there speculating that there's going to be at least 2 more raises by the end of the year, probably take the Fed rate up to 5.6%.
Yep.
Which, when you're getting basically prime plus 250, I mean, that's your mid 8s.
Exactly.
For in the middle of the road there. Right?
Yep.
I mean, that could get really high. So what do you anticipate happening through the end of this year?
Your guess is honestly as good as mine. Obviously, we both study the market. We both study what the Feds are doing. I would like to say low 8s to high mid 9s by the end of the year. Prepare for that. Yeah. I know a lot of investors right now are sitting on the sideline. I want to encourage, if you find the right deal, don't wait because we don't know what next month looks like. And so be aggressive. Sit with good liquidity within yourself, sometimes that may look a little bit different. I know a lot of guys are bringing on partners to help with the equity injection right now. That's always a great option. I know that people ask me almost every day, who has that kind of money to be able to throw down 35, 40% on a deal. But that's a great option to, identify some partners for a deal. You don't want to borrow it. You don't want to have two loan situation from that partner, but bring them into the deal. Set yourself up for success and have low leverage within the institution that you finance with.
Yeah, that's kind of how we're acting right now. Is like, let's just wait for the right deal. Yep. We're going to take our time. We're not going to put too much leverage on it. How can we, because our approach right now is like, we're going to JV. Yep. Let's go find the guy that already owns the land so that we don't have to buy the land, and we'll just partner with them. We'll bring the debt.
Yep.
And then, we can do that deal. I can raise equity to cover our debt payments and cover that while we're under construction or doing whatever we need. Because, it doesn't mean that just because interest rates are high and the market's uncertain doesn't mean that you shouldn't be buying real estate, because, we all anticipate, I think, in the next 18 to 24 months, interest rates coming down, and it's going to make a whole lot of sense to just refinance then, and at least you got the deal.
I'll stop you right there. Modifications are options at a lot of institutions. And so even if you do take down a property right now, 2 years from now, say the rates are down 2%, might make sense to go to your bank or your credit union and ask for a modification and see if they'd be willing to do it. And then that way you don't have the expense of a refinance.
Exactly, because a lot of the times these smaller banks prefer to keep the loan.
Absolutely. Right? We all want to service it. We all want the relationship.
Yeah.
We work hard to bring them on. So why would we just, push them out the door?
Yeah. Yep. Yeah, it makes a lot of sense, because then, if that bank's not going to do it, or credit union, you're going to go refinance with somebody else and take that business somewhere else.
Exactly. Absolutely.
How big are deposits right now? Everybody seems to be talking about, every lender I've talked to, usually they say, hey, can you put some deposit with us? And typically what we'll do is like, we'll keep a small operating account with you, like barely six figures. And now it seems like everybody is just, we want everything that you have just to get these deals done. So.
Absolutely. So deposits are king, right? Because in most cases, and in a lot of cases, we are lending based off of what deposits the institution has. I will also point out the great thing about working with me, I don't require any deposit accounts. We always appreciate them, but we don't require them. I know with my selling points, that's one of my selling points is we don't require the deposits, but they're always appreciated. So, But a lot of my competition out there does require 10%, 12% of the loan balance in deposits. And so, if you're able to, you might be able to get a much better, rate than if you're not bringing a deposit account.
Yeah, exactly. Because then you're putting all the liquidity with the bank.
Absolutely.
And they like that. They can lend out a whole lot more than what you're giving them. So exactly, makes a lot of sense for them to give you that loan.
And that's what we call relational banking. Is when they're bringing in the deposits and you're able to loan based on how much they're bringing in on deposits. And so that's going back to the rate question of, some banks are able to offer a lower amount. A lot of times they're offering that lower rate because they're bringing in a large balance. Yep. So if there are any guys sitting out there with money markets are great right now. I'm seeing rates in 5% range. So if there are people out there,
that's so crazy, man. I feel like a couple of years ago, it was like you'd get
we were fighting for negative 1%. Yeah, we were fighting for 1% on the money market, and now they're at 5%.
Man, what a time to be alive. So we met last week, and I know y'all are not going after Airbnbs because we're looking at developing some Airbnbs.
Yep.
But we did talk about a couple of things that y'all are interested in. So what are y'all looking for right now?
Absolutely. So first and foremost, multifamily is great for us. It's a product that we feel very safe. So multifamily industrial is huge right now. We're seeing a huge demand for industrial, which obviously drives up the prices, but it also drives up the rents. So self-storage is still a great asset to lend on. And then also one thing that's been newer within the last year or two, I know it's been successful, but a lot of institutions have a lot of appetite, I'll call it, for medical office. So obviously
not traditional office.
Yes, obviously traditional office is not something we all have a lot of appetite in. So
It's funny. A medical office is popping off.
Yeah. Oh, it's crazy how well it's doing. And it's obviously a great opportunity. I don't know if anybody that's watching has a medical practice, doctors, nurse practitioners. It's a great time to look to buy owner occupied stuff.
Yeah. Yeah. Because people are going to go to see their doctor, whether it's an up economy or down. It's kind of like a liquor store, man.
Absolutely.
Liquor stores and medical
Absolutely.
offices.
Yeah.
Good economies, bad economies. So what are your thoughts on retail right now?
Retail, we're still pushing.
Are you?
I still really like retail. Have had probably 6 closings within the last year on the retail side. So both multi-tenant and triple net, single tenant.
Yeah. I'm a big fan of retail. I know everybody likes to talk trash about it over the last 10 years because of Amazon. But if you're buying the right retail, it doesn't matter.
Absolutely.
I mean, we still bought a 330,000 square foot shopping center a couple of years ago, and it's doing fine.
Yeah.
I mean, we're going to redevelop it. We're master planning it right now, but it's cash flowing.
Yeah.
Like as is,
Yep.
and it stays full.
All of my clients that have bought retail strip centers are doing fantastic. Right now. Yep.
Because I mean, I understand. I get the whole e-commerce thing. But there's so much on a day-to-day basis that I don't want to sit around for a day or 2 days, which is funny to think about, right? Because,
Yep.
I mean, back in my grandparents' day, which wasn't that long ago, you used to like circle a thing on a Sears catalog and mail it off, and you'd get it 4 or 6 weeks later. Now we're all spoiled, and 1 to 2 days is too long. But, like, I'd rather just drive and go get it on my way home.
Totally agree. There's something about picking something off the shelf rather than picking it up off of your doorstep.
And seeing options.
Yeah. Absolutely. I can't tell you how many times I've ordered something off of the big box store on the internet and I've gotten it and it either doesn't fit or it's not the right product or it's not what I thought I was getting.
Oh, yeah.
And so being able to walk in a store, totally on the same page.
It's funny. I feel like they've made returns fairly easy for an online shop, but it's still a pain in the ass to return anything to Amazon.
I've got something that had a 30-day return window. And it's still sitting in my closet because I never made it up to the FedEx.
Yeah. Or to Whole Foods or whatever.
Exactly.
It's just it's too much of a pain. So it's
one thing about retail that I'll share with you.
Yeah.
This is an awesome story. So I was talking with a broker that had a big box store that moved out. So they had a large vacancy. This is here in Nashville, in Middle Tennessee, and I haven't heard any news articles on it, so I might be putting it out for the first time, and I won't say who or where, but. They have a tenant that's opening up an indoor pickleball court.
Oh, sweet.
Inside of the big box store. And I
really
think that is going to be a huge success.
Oh, that's super cool.
Yeah.
The amount of calls that we have gotten on pickleball courts, people wanting to open up pickleball shops is crazy to me.
Yeah. Absolutely insane.
It is wild. I mean, it makes sense. It's the fastest growing sport in the United States. I mean, I was listening to a podcast the other day that they don't think it's too far off from being in the Olympics.
Oh, would not surprise me at all.
How cool is that?
And the great thing about it is you got all ages. I know my kids' grandparents play. If that tells you anything.
It's super cool. I played it for the first time over at a buddy's house not too long ago, and man, it was fun.
One of the local networking groups has a pickleball tournament coming up here. So
I might have to get out there and start networking with some people. It'll be a lot of fun. Okay, so it sounds like multifamily, industrial,
absolutely,
medical office,
yes,
and retail, which is, what about hospitality? I guess that's the last one.
Hospitality is coming back strong. Institutions are getting more and more comfortable with it. It has to be the right product.
Right.
For instance,
I'm assuming you want it flagged, like you want a branded hotel.
Absolutely. Yep. And, stabilization within this market is very important. And so to see a stabilized asset that month over month has a great T12, for instance, that is a easier sell to my underwriting team than something that has no income coming in and we have a pro forma that might not be realistic numbers. And so if I'm able to
surely that's not happening,
I
right?
know,
Come
right?
on.
Nobody fits
every pro forma is right.
Yeah. So having stabilization, having T12s, having even the seller's tax returns, if we could get just their Schedule E or, the return that shows what their income and what their expenses are, really helps out my underwriters, and they always really appreciate it. And kind of to talk on that, having a complete package ready to go for your lender rather than having your lender come back and ask for more and more and more,
Oh yeah.
is so important because it gets you to the closing table faster, as well as really takes a lot of, time away from the lender. So
Yeah, we've got a lending checklist that we use internally.
yes,
That that way everybody's on board with like what has been sent and what hasn't. That we actually threw in the course because of that.
yeah,
Because you know if you've never gone through the process before, you don't know what it's like for a lender to
exactly.
get 37 documents
Yep.
in 20 different emails, and
Exactly.
then they're trying to scramble, and then I don't think I got this. Can you please send your tax returns, or what happened to this K1? It's a total pain because
Yep.
I mean if you invest a lot, it's a lot of
Oh
documents.
yeah, absolutely. And to that, I know a lot of people have multiple entities, and when you have multiple entities and you own 20% or more of that entity, then we need those tax returns and those financials as well. I recently had a borrower that had 18 entities and he owned 20% or more. And so I needed to get 3 years
Jeez.
tax
Oh
returns and
man.
financials on all of those.
I bet your underwriter
Yeah,
loved that guy.
absolutely. Absolutely. So, but
That's crazy. So I guess let's dive into that a little bit further.
yeah,
So if I mean, because it's especially relevant today, right? I mean, we're talking about how to finance your projects, your real estate in 2023. If I'm coming to you as a lender, what is going to be involved in that package? Like, what do I need to present to you? Because, as real estate investors ourselves, I mean, we all know we want to come off as professional and as put together as possible. So if we can just go ahead and deliver one, nice little package with a bow on it, makes
absolutely.
your life much easier.
Absolutely. So, first things first, we want a personal financial statement. In most cases, all institutions kind of commingle. So if you've kept a up to date personal financial statement, and when I say up to date, I would say within the last 3 months, we are able to take any institution's personal financial statement. Also, business debt schedule. It's good to know what kind of loans you have that you're paying on right now and that you're on the hook for.
Yeah, so you can figure out the global cash flow.
Absolutely. 3 years tax returns are pretty much the industry standard. I know some institutions only do 2 years. We personally do 3 years. I would rather know everything about you.
Yeah.
And that's, I sometimes people will gripe or ask questions about it. And I'm like, hey, I want to make sure I know exactly who Tyler Cobble is. I want to see what you've been able to do in the last 3 years. And so I work with my clients. Some of the I'll go through the list and then I'll kind of hit up a couple different things about this. But so 3 years tax returns, business debt schedule, personal financial statement. That should get us to a point where we have a partial package, as I would refer to it. And so I'm going to start, digging into those financials. Once I look at your tax returns and I see business entities or a K1 or something along those lines, I'm going to ask for, hey, what's the partnership? What's the ownership level of that K1? If it's more than 20%, I need those entity docs as well.
Right.
If you're a W-2 employee, I'm going to be asking for a pay stub, your last year's pay stub, last pay stub, to give me an idea of what that W-2 income looks like for the upcoming year. I know right now, for instance, a lot of investors file extensions, and so having a good profit and loss and balance sheet that I can be able to give the underwriter is important because we don't have that 2022 tax return yet.
Oh yeah.
Yeah.
That we're dealing with that left and right. Like, oh, please send me the extension. Please send me the extension.
Absolutely. So, but to that, where I was going to go, as I was kind of giving you an idea of the package that we want to see, it's important to have a team around you as an investor, whether it be a single member investment or it might be a Tyler Cobble group. It's important to have a good CPA. It's important to have a good property manager. It's important to have a good lender. I always tell people have 3 good lenders, and then you can keep us all
At
honest
least,
and know
especially now.
Exactly. Maybe now in this market, have 6 or 7 lenders that are going to be looking out for your best interest. And but also introduce each team member so that if I need Tyler's tax return for 2022, I can go straight to your CPA and say, hey, my underwriter needs this. Tyler, I know how busy you are and how many phone calls you're getting in a day. I'm able to go straight to the CPA and get it rather than go to you to go to the CPA. And it takes one extra step out of the way, and it saves a lot of time.
Oh yeah, Allison, my CPA, she jokes all the time because she just gets copied on responses where it's just like, Allison's copied.
Yeah,
or please
absolutely.
send to Allison.
To that
because
point,
I just
Allison
make my life
and I've
easier.
had lunch.
Yeah, exactly. She's great.
Yeah.
You know, I mean, she's out there doing all that stuff for me so that I don't have to worry about it.
Exactly. Absolutely.
Because the last thing I want to have to deal with is putting together a financial package to send to a lender. I mean, it's just it's a lot.
So,
and I want to be the guy you want to hang out with and talk on a podcast to.
Yes, exactly. So to that, let me finish up the package. One thing I left off, a lease. I want to see what that lease looks like. And if there's any historics that we can get from the seller, I want to see what those historics are. Because like I pointed out, the pro formas sometimes are a little bit iffy. And so I want to see what the historics are on the property. And but yeah, that would finish us up. And then as my underwriter goes into the deal itself, he may have some certain questions, but that would be considered a full package.
What about vacant properties that may not have leases on them? You know, how do y'all look at those? Because that's typically what we're doing, right? We get these heavy value add because we know if we get in there and fix it up, you know, I've got a leasing team and I've got a management team. We've done that time and time again. You can often push for much better returns overall, get a better value on buying it, get a higher value on selling it because you've got new leases in place. So how do y'all kind of evaluate that?
So on that, we're going solely off of the comps within the area, but then we're also going off of your pro forma. Lower leverage, most likely on the loan. You're not going to see a 80% LTV or a 70%.
Okay, I'll take 79.
Yes, exactly. But you're going to see a lower leverage loan in most cases. There are institutions that are willing to, do that, but in the majority of cases, you're going to see a lower leverage loan. And then we're going to walk through the process. We're going to be a lot more hands-on with you. Where especially if it's a high value add and there's a construction element to it, we're going to be doing site visits. We're going to be talking to you on a daily or weekly basis.
Oh yeah.
I'm going to be talking to you more than your childhood best friend probably at that point.
Yeah. And I like that because you want, I feel like a lot of investors forget this part because like, oh, the lender's just giving me money. The lender's the lender.
Exactly.
The lender's the biggest partner in the deal, right? Like y'all have a vested interest in making sure this is successful because y'all don't want the property back. Exactly. You don't want any of that. And I feel like, people just don't take that part seriously or maybe just don't even think about it because if you've got a really good relationship with your lender, it'll help you survive a 2008. 100%. Like, hey, I know we're not hitting our debt service coverage or we're not, at the point where we thought that we were, but here's how we're working to get there. Work with us. Most lenders don't want to take properties back.
Exactly. We're in the business of lending money. We're not in the business of being a landlord.
Yeah.
And so with that, communication is key, especially in this market. There are times that 1 week my rates are one thing. The next week they go up 0.25%. It's not something that I enjoy. It's not something that I am doing.
Yeah, you can't really control that.
Exactly. But the important part is us having a relationship, and that I'm not just retrading the deal. It is literally something that's out of my hands, and you have enough trust in me. And so on through the project or on through the transaction, that's why communication is so important because it's a lot easier. Yes, in our business, we have to have tough conversations, but it's a lot easier to have tough conversations with people that you love to hang out with and love to talk to rather than somebody behind a computer screen sitting at some corporate headquarters.
You see that all the time, man. I mean, I feel like that's one thing I've always tried to be very intentional about in my business is let's get face to face or let's talk on the phone. If I'm delivering bad news, I'm not going to send you an email. And I think way too many people just rely on like, I'm sending off this email. I'm not going to worry about it. And that just makes matters so much worse.
Absolutely.
So much worse.
Pick up the phone.
Yeah.
Yeah. I mean, in my personal life too, my wife drives me crazy because she'll be sitting there texting her friends in a 15-minute text conversation. And I'm like,
just call them. Just FaceTime them.
Like, come on.
Yeah. So right now, what are your tips or what's the strategy for investors today to still secure financing on their properties? I mean, what do you think is the best way to go about that now?
I know this might not be the popular answer, but cash is king right now. The importance of having a lower leverage loan because of the debt service. it's important to get the leverage as low as possible, as low as you're willing to make it. So cash is king. Patience, like you hit up earlier. Don't jump at something that might make sense. Jump at something that absolutely makes sense. There's a lot of deals that a lot of people are sitting on right now that make absolute sense, but they're timid because of the market. I want to encourage those people, jump on it if it makes sense numbers wise. Jump on it, move forward with it. But at the same time, if you're having to really squeak by or come up with some numbers that might not truly add up, don't do it.
Yeah, now's not the time to take that
you're
risk.
going to put yourself in a bad situation. You're going to put your team around you in a bad situation.
So when you say lower risk, I know you said get it as low as possible,
Yep.
right? Are you talking lower as in 50-50, or does that mean 75-25?
I would say as far as lower leverage, it's probably going to be a 65-35.
Okay.
That's what I've been seeing kind of across the board for the past 6 months. There are institutions that can go up to 80%. We personally are, per policy, we've always been a 75% LTV lender. But with that being said, putting a little more skin in the game gives more confidence in the institution.
Yeah, 75-25 or 70-30 is typically where we aim.
Yep.
Because the amount of risk for the additional 5% at 80-20
exactly
is not really worth it.
Yeah.
It decreases your debt service coverage ratio. I get it. You're now having to pay investors a higher return for that 5% than you would have to pay in interest on the bank. But at the end of the day, it gives the lender confidence. It gives you more confidence. It gives your investors more confidence because 100%. They know, like, hey, this thing isn't leveraged to the gills.
Exactly.
And, to your point earlier about y'all not wanting to take properties back, I know that, I wanted to take this property back, but for my first seller financing deal, it is so much easier to just sit back and collect a check every month.
Yep.
Not have to worry about the property taxes getting paid, not having to worry about the building being secure, because everything else is in place. You're like, cool. Pay me my money.
Absolutely.
I don't care.
To that, even in this market, we're still, the delinquency reports, the delinquency rates are still looking
They're low.
great.
Yeah.
And so let's keep it up. Let's keep doing that.
Let's keep it that way.
Like you said, we don't want to be collecting rents from your tenants. So, it's a strong market. Obviously the prices, brokers, we'd love to see your prices come down.
Yeah. Well, by my calculations, and I know this is probably very unpopular, real estate values are down 17%.
Yeah. Yep.
And so the way that I did that for anybody listening that wants to know how I came to that conclusion, because you could use this as an argument to try and get better pricing out of your sellers.
Yeah.
But if you're getting $1 million loan at, this is 20-year amortization, 5.25%, your mortgage, I want to say it was like right around $6,800 a month.
Yeah. Sounds about right.
For $1 million. Now, if you take that same 20-year amortization, same $6,800 a month payment, but you change the interest rate to 7.5%, your loan possibility goes down to $836,000.
Wow.
That's a 17% decrease in the loan value. And so, you can take that and adjust it any way that you want, but that's how I'm looking at it and going, I think everything's down about 17% right now.
Absolutely.
People just aren't realizing it because they don't want to admit it. So Brent, I pulled my Discord server and my Instagram channel. I want to ask you some of my favorite questions that came in. You kind of covered this earlier, but just real quick, where to start? If you're new to commercial real estate, how do you start? How do you build a relationship with a banker? How do you impress them enough to give you money?
Yeah. I think for a lot of institutions, they want to see somebody that's seasoned, right? And so where I would start is most major metropolitan cities have a networking group of some sort within the commercial real estate world. I would start hitting up those groups and find those seasoned guys, learn from them, drink in anything and everything that they're putting out, because if they have been in it for a long time, they've obviously been successful and they're doing it for a reason. Also look for sponsor opportunities, right? If you're brand new to it and you don't have anything, I get a lot of calls from brand new investors that want to buy a 100-unit apartment complex.
Oh gosh, I bet you get those.
Yeah,
Thanks, Grant Cardone.
Exactly. So with that, I always tell them pull the reins back, right? It looks like a great opportunity, a great deal, but have you ever dealt with tenants? Have you ever dealt with a property manager? Have you ever dealt with all the things that come with owning a 100-unit apartment complex? And so I always tell people, pull the reins back, start with a 5-unit, a 10-unit apartment complex, get your feet wet. Maybe even in that case, you need to bring on a sponsor that would be willing to partner with you to be able to build that up. Also, one thing that I'll point out, there are calls that I receive that somebody tells me they're an investor, and I start digging and asking questions, and I find out that they just recently became an investor, but they don't own any real estate yet, and they just quit their W-2 job. Even though it's an investment property that we're looking to buy, I can't base it just off of the income of the property. I got to have income to be able to support the deal itself. So do not quit your W-2 job before you buy your first couple deals.
I see too many people make that mistake.
Yes,
I mean, because the W-2 income, banks love that.
Yes.
I could make 5 times more as an entrepreneur than somebody with a W-2 income, and they're going to go with the person that has a W-2 income.
Absolutely.
Because they're like, nope, less risky.
All day.
It was so fun. Dude, the first 2 years of starting my business was painful because everybody wants to see the first 2 years of your business, and you're like,
but here's all the things I want to do.
Yeah, I can't do anything.
Yeah.
Okay, that's great. Yeah,
so I hope that answers, but I would say network. Get out, see the guys in the community, get to know the brokers, get to know property managers, educate yourself. I know it's a lot of late nights and stuff like that while you're working a W-2 job,
for sure.
But in order to get started, blood, sweat, and tears is really the only way to get started.
How worth it to you is
Absolutely.
it? You know what I mean? Like how much you want to put into it. I mean,
and that goes a long way too, from a lender's perspective.
Yeah.
When I hear your story of how you got started, I look at you, how you got started. It really makes me appreciate the effort that you're putting into each deal because of what you were able to put forth when you got started.
Oh, 100%. And that was how I got started. I networked like crazy until I met a guy that owned 3,000 doors.
Yeah.
And then I was like, hey, I want to show you my offering memorandum for this deal. I want to syndicate. I've never syndicated before. I know you've syndicated a lot. I would just appreciate your feedback. I wasn't trying to ask him to come into the deal. And he reviewed the offering memorandum, which was total garbage compared to what we put out now today. And he was like, look, I'll give you my feedback if you want it, but I want to partner with you on this deal. I was like, perfect. That was what I was hoping for.
That's awesome.
That's what I was really hoping for. I mean, he could have stroked a check for the entire deal.
Wow.
And I didn't have to worry about it. The lender was like, take all the money you want,
Yeah.
Because of his balance sheet. And so I didn't have to, I raised capital based on that. It was the greatest thing ever.
How'd that relationship go from?
Went really well. We knocked it
awesome.
out of the park. I mean, he made me do everything.
Yeah. Oh yeah. 100%.
But I wanted that.
Yeah.
I wanted to be the guy in the trench because I wanted to learn A to Z. How does this whole thing work? And so we've looked at doing some other deals together, but he's more on the multifamily side.
Yeah.
So it's just a little bit more difficult because I like funky deals.
Yeah. No.
Yeah. This is an interesting one because it's a little bit different. What is your opinion on 100% loan to value seller financing on a commercial property?
The 100% seller financing worries me because one, obviously you have a paper agreement, but you don't have an institution that you can fall back on. If, for instance, that seller wanted to pull the note at any given time, a good attorney is going to be able to get them out of it. I'm open to seller financing at a lower leverage. And I know I sound like a broken record, but it also reduces your risk as the investor if you've got some money in the game as well. One, it gets that payment down, but then two, when you're turning around, I'm working with a borrower right now that's refinancing out of seller financing. And one, getting the documents and the promissory note and everything is a nightmare because they're like, I don't know where it is. What, who did it? Where is it? That kind of thing. But then also, when you're dealing with an individual that may or may not know exactly what they're doing, that creates issues down the road.
You never know.
So seller financing can make sense. And in this market, it's a good idea, but make sure you're doing it with the right seller.
Yeah. I mean, I just ran the math and, 20-year amortization, 5% interest, which, if you're getting seller financing, you should be able to negotiate a pretty good interest rate.
Yeah.
$1 million principal value. So let's assume the property is $1 million. Your payment is $6,600 a month. Whereas if you drop it, let's say you put in 200,000, right? So
Yep.
now your principal value is 800,000. Drops your payment down to 5,300 a month, and 1,200 a month may not sound like a big difference, but if you're trying to get the property rented,
Exactly.
that could be the difference between you actually making money
Yeah.
every month or just barely covering your note.
Absolutely. And then when you throw in the expenses of owning a new property too, you got to weigh those out.
Oh, yeah.
So
And,
yeah.
and you've got to wonder too what's in it for the seller.
Yeah.
Because if I was selling a property, no way in hell would I do a 100% financing, because I want you to put 5, 10, 20% down up front, so that if I'm foreclosing on you, I get to keep all of that plus every payment you've made.
You got all the equity and
that's exactly right.
It's important. I know that institutions want lower leverage, but I want to speak to the investors out there. Having equity in a property is important.
Oh, yeah.
I, for instance, love doing equity injections. So if you own a property and it's at 30% loan to value, I'm going to use your equity and apply that towards the purchase of a new property, so you don't have any cash out of your pocket. It's just the equities being transferred from one property to the next.
Right.
And it really is a value to my clients, and the institutions, for the most part, they're willing to do it. And so, if you do own any properties right now and you have large amounts of equity, definitely look into equity injections.
Yeah, it makes a lot of sense to do that. I mean, I am more conservative. I mean, I get aggressive on the types of deals that we do, but I'm more conservative on the financing side. Fix or float with a rate cap?
That one's tough. So I only do fixed, and
which is my opinion. Yes. You should do fixed, but
and the investment world, the commercial real estate world, it is all about taking calculated risk, right? And numbers are key to success. Depending on where the cap is, it could make sense, but if you're basing your numbers off of a 5.5% rate, and then all of a sudden it jumps up to a 7% rate, that's a big difference when we're talking about maybe possibly a couple $1 million.
Oh, yeah.
That could really put a dent in your profit as an investor. And so, not knowing the specifics of the cap and stuff like that, I would say be cautious with a floating rate.
Yeah, well, and that one's tough too, because a lot of lenders don't want to necessarily put a cap.
Exactly.
Because they're like, well,
or the cap's going to be like 10%,
or they're going to put a floor.
Yeah.
Right. And so it's like, oh man, which one do you want? Because if you're going to put a cap, they're probably going to want a floor, and that could actually end up coming back to bite you.
Yeah.
I mean, using my seller financing example earlier, the deal that we did, when we closed on that property, rates were 7.25%, prime plus 250 or whatever it was, or prime plus 150. I think it was what everybody was doing then. So 7.25%. We made that the floor. I mean, again, the guy threatened to sue me, so I was not being very kind to him.
Yes.
But 7.25% was the floor. And we set it to Wall Street Journal Prime plus 150 BEPS, floating monthly. Yeah. And so to put this in perspective of what an adjustable rate mortgage can do to you, he's paying 9.75% interest now, 1.5%, 2.5% more.
And imagine covering the debt service on that.
Oh, he's paying me $21,000 a month, interest only. Yeah. And there's zero income on that property. So it's not a good position. Apparently we're going to get paid off. Yeah. We had to send over our payoff letter. So we'll see. We'll see. Yeah. I'd prefer to take the property back.
Exactly.
This is a good one. What types of lenders are best at being creative with loan structures?
Yeah. So that I can really speak to on the credit union side.
Okay.
Credit unions are typically a lot more advantageous as far as the rates. We're able to be competitive within the market. Nothing crazy. It's not like getting an agency deal or a life co deal in the low sixes, but they're able to be competitive. But also, again, to give you an example, I looked at a deal today, had 2 years left on the lease. They didn't want to do a coterminous term on the actual loan. And so what I offered was to get creative. I said, how about, they were asking for 60%. And I said, how about I do 45% up front and then do an additional funding once that tenant renews the lease, and do the additional 15 at that point, because I'm trying to think of the best way to do it for the borrower, but I'm also trying to say, hey, what makes sense on the consumer side, the bank side. So what makes sense for the credit unions, what makes sense for the borrower, and so that's a way to get creative within the market, saying, hey, this doesn't make sense, but I'm not going to put a 5-year lease, a 5-year term note on a year and 10 months left on the lease with a large big box store as the single tenant.
Yeah.
And so creativity in this market is key. And really, going back to it, community banks are also a great asset within your community. Of, hey, here's what I'm looking at. A lot of times they still have that mentality of, my handshake means more to me than a signature on a piece of paper.
Which is so important.
And credit unions alike, I can truly tell you, my handshake means more than a signature on a piece of paper. So, but yeah, I would say community banks and credit unions are probably in this market the most likely to get creative.
Yeah, I mean, your regional guys don't care.
Yes.
You know, I mean, I've got a loan with a regional group because it's just a bigger deal, and it has been a pain trying to get, we had an additional line of credit for about $700,000 on the loan to finish out some of the buildings on the property, and man, just getting them to release that, you're like, come. You shook my hand. You said we're going to do it. Exactly. What the hell? Like, I don't operate.
Got transferred to the other branch.
He did. Yeah. Oh man, it's the worst. Yep. It's the worst. Let's see. What was some other questions that I had going on in here? Okay. General qualifications and terms to expect for refinancing a new commercial building owned less than 2 years.
Yeah. So it's funny, as I was walking in, I was having a discussion with a borrower. Seasoning periods, most financial institutions have a 12-month seasoning period. The borrower that I was talking to on the way in here, he had a particular situation where he paid cash for an industrial complex that was 100% vacant. He bought it with cash, got a tenant to sign a 15-year lease. Obviously, he is adding value to that property by getting that lease. And so in situations like that, we're able to overlook a hard seasoning period and say the value changed because
there was a significant improvement. Yeah.
But consistent terms, I would say like anywhere from 6.5 to 8.5. I'm sorry, I'm not more specific on the rates, but I would say anywhere realistically 6.75 to 7.25 on a rate. And I'm not sure what did they say, what kind of asset class?
I don't think that he said. I think he just said it was commercial.
Okay, so 6.75 to 7.25, 5-year term, 25-year amortization.
That's pretty nice.
Yeah, absolutely. And one thing I'm leaving out in the credit union world, best part about it, and I know some banks are able to, but for the most part, I'm seeing a lot of competitors that have prepay on their loans. Credit unions, for the most part, we do not have prepays, so no prepay with that loan.
That's great.
And 5-year term, 25-year amortization.
I mean, that makes a big difference in your payment. It's almost 10% a month.
Yeah.
I mean, just running some quick numbers. I mean, going from a 20-year amortization to 25-year amortization. I mean, that's how you can kind of mitigate the interest rate hikes.
Absolutely.
You know, is get a good relationship with Brent.
Yes, exactly. Come one, come all.
Yeah, come one, come all. Well, Brent, this has been great, man. Appreciate you coming into the studio.
I appreciate you having me, and proud of the success you're having. And I see that you've got a huge following now on YouTube.
Yeah, I don't know how that happened.
Largely growing. It's probably those videos you guys put up last week. I saw you sitting outside of a vape shop.
Oh yeah. Oh my gosh, you saw that one was hilarious. We had a lot of fun with that. That was really all Zach over here.
Yeah, nice work. But thanks so much for having me.
Yeah, absolutely, really man. It's been good. I'm looking forward to working on some deals with you. If anybody watching or listening wants to talk to you about doing some business,
call me on my cell phone, 615-891-0224.
There you go, making it
Yeah,
easy for everybody.
exactly.
Brent, I appreciate it, man, and everybody else. We will see y'all next week.
Thanks, guys.
Thank you for listening to the Commercial Real Estate Investor Podcast, brought to you by Hamilton, your resource for passive real estate investment opportunities. Visit www.investwithhamilton.com to start building your passive real estate portfolio today.